Gold is the focus of today's Best of the Decade series. The commodity up 280% in the past 10 years. But with rising interest rates inevitable, can the trend in bullion continue? Rachel Benapy is portfolio manager of the 5-star Morningstar rated First Eagle Gold Fund, which ranks in the top 10 for its 10-year performance. Her fund is up 437% in the past 10 years and up close to 40% this year. Rachel is with us here at the New York Stock Exchange. Good morning.
Good morning.
What do you think will happen next year with your fund?
Well, we continue to view gold as our insurance policy. So we view gold as the ultimate insurance against any of those downside, any events that you think you need downside protection against. So if it's inflation, deflation, fill in the blank. And we're currently in an environment where we have stimulus packages going on around the world, and we have no idea really how we're going to exit those packages. So in case something does go wrong and there's unintended consequences, we feel gold will act as insurance for those events.
Gold has done very well this decade.
Yeah.
This decade has also been a decade of little or no inflation. So I don't get the link to
Well,
inflation.
I think if you look at the 90s, we had central banks were sellers of gold. And when central banks are selling gold, the gold price can't hold up. And so when we started the decade, gold was at around $250. It was at really a depressed price. Then we moved into a period of, let's say, 2002 to 2007, where gold moved up with all assets. It was really in 2008 where its role as an insurance policy filled in. So we had the Lehman crisis, the world falls apart, gold finished up on the year where equities were down 30%.
Well,
I think kind of going forward, central banks, as they want to diversify their holdings, and as they worry about currencies, as they worry about how their respective other central banks are going to handle their currencies, they start to diversify, and gold becomes a substitute currency in that instance.
a skeptic might suggest that that means that the gold market can only hold up if it's manipulated by the central banks.
Well, I would say that its investment demand is what drives it. If you look over the last several quarters, it's over
But absent
3 quarters.
demand from the central banks?
Absent demand from central banks and from large institutional investors, gold is likely not going to do as well. I mean, the major driver for gold would be institutional interests, central banks, hedge funds, etc.
All right. So you've had a banner decade. You can't argue with that. Up 437% for gold. The next decade you expect to do well as well?
We think that because at First Eagle, we hold a combination of both bullion and equities.
Forget that question. There's one more I want to ask because we're running out of time. And you mentioned it's an insurance policy. There has been, again, in the decade of the Audis or whatever we want to call it, there have been a lot of upsetting international events. And right now we've got Iran perhaps rattling a nuclear sword, and gold hasn't responded to those. I remember in the old days when gold would shoot up if someone started shooting guns off. Lately that hasn't been happening. How is gold an insurance policy against that?
Well, I think it comes down to trust. So I think if there is actually more of an escalation, if there's a feeling that Iran, let's say, is serious this time, or if there's actually an event and people are concerned, it becomes a trust issue, and gold at that point becomes your ultimate substitute currency.
All right, so we're out of time. So I take it from your logic, then, we now have a buying opportunity in gold because it's come off quite a bit from the high.
I think the need for insurance is as real today as it was a year ago.
All right, you won't commit to that either. Thank you, Rachel.